thriving business.
Thanks to a
It all starts with that one simple step. So what are you waiting
We're seeing some
for?
green on the screen. The S&P 500 up
Grab your
0.3%,
phone,
1%. The Nasdaq
hit
Composite
record,
up the same. This is Bloomberg.
and let your idea fly. The future of your startup could be just one video away.
Remember.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, shares of Micron Technology, they are the biggest decliner in the NASDAQ 100. They are right now down, I think, about 16.5%. Yep, pulling it up just off their lows of this session. So big hit, down the most in more than 4 years since March of 2020. And this is coming after the largest U.S. maker of computer memory chips put out a revenue forecast that missed projections, reflecting sluggish demand for smartphones and personal computers. And then there's also a headline involving Intel that we kicked off our hour with. So we've got a lot to talk about when it comes to the semi space.
Yeah, what we need to know when it comes to Intel, Micron, and the broad world of semiconductors. Here with us is Bloomberg Intelligence semiconductors analyst Jake Silverman here in our Bloomberg Business Week studio. As Carol mentioned, Micron selling off big time, 16.5% to the downside right now. Worst day going back 4 years. Sluggish PC and smartphone demand. Yesterday when this broke, I was thinking to myself, didn't we know about sluggish PC and smartphone demand? Why is this such a surprise?
Yeah, so part of that is that this is more so an inventory correction than it is actually a change in demand profile suddenly. So over the last, it seems like maybe 6 months, 5-6 months, there was a buildup of inventory.
Which happens in the semi space.
Yeah, it does. It happens all the time.
Yeah.
It's frequent. You go through up cycles and down cycles.
Right.
And so PC and smartphone customers were building up inventory ahead of price increases, which did occur. And so now what's happening is they have adequate levels of inventory and demand isn't necessarily that strong. So there's not a lot of demand for Micron's memory chips right now.
So is it kind of like, whoa, 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 investors understand that the reason there's sluggish demand is not that, we've known about the troubles in the PC market, but it's not like everything's going to hell in a handbasket, right? It's just a case of people had built up inventories.
Yeah, sure. No, and there's also something to keep in mind, though, that there's a number of different moving parts. I think there's obviously the AI aspect of it, but people are also, I think, somewhat concerned about just how prolonged this inventory correction will last and how much excess inventory is actually in the channel right now.
Because I thought they kind of checked the box when it came to AI, their AI demand.
Was pretty strong, yeah. I mean, data center-related demand grew 46% sequentially, so.
Well, remind everybody where they play in this space, where Micron fits in. If you look at the supply chain analysis feature on the Bloomberg terminal, you see that Apple's one of its biggest customers, Dell, LG Electronics, WPG Holdings is actually its biggest customer. Where does it play?
Yeah, well, so it's pretty broad. I mean, every consumer electronics device, everything that, every electronic device needs memory, it needs storage to some extent. And so what's been happening is, over time, over the last several months, last year or so, demand has improved a lot in the data center. So now you're starting to see more demand from customers like NVIDIA, as well as other like ASICs as well, the customers of Broadcom and Marvell, who are also, creating their own AI servers or, ASICs.
Hey, Chick, one thing I'm going to, as you said, the data center related revenue did okay. It grew 400% in the quarter. That's pretty okay from a year earlier. The unit now accounting for more than half the company's total sales, but it wasn't enough to offset the weaker orders from makers of devices aimed at consumers. Having said that, is the data center what this company really becomes, that area in the future? Like that's going to be the dominant business?
Yeah, I mean, it depends entirely on how much additional AI infrastructure build-outs occur. If there's continual incremental spend over the next decade or so, But the thing is, high bandwidth memory is an area that they're seeing a lot of demand for, but it's still so early for them. So what you're seeing a lot of the data center demand or growth this past quarter was actually not necessarily all related to HBM. In fact, the vast majority of it was actually like high capacity modules, as well as LPDDR that goes into servers and AI servers. An area that was a little bit of a concern was actually that data center SSDs, though, took a bit of a pause. They've moderated in terms of demand. We're not exactly sure if that's how temporary that is.
Hey, Jake, I promised we'd talk a little bit about Intel. We learned just in the last hour that Intel has shortlisted a number of buyout firms for the next round of bidding for its Altera unit. This, according to people familiar with the matter. This is the chip maker faces headway on a process started by its now ousted CEO. What does our investing audience need to understand about this?
Yeah, no, I mean, I think for Intel, it's just an opportunity to really unlock value. We've seen them do very similar plays with with Mobileye, for example, and one of their other businesses within their foundry. So this is an opportunity for a pretty high margin data center mostly play, but still somewhat diversified in Altera for Intel to get some much needed cash.
All right, so it just sounds like stay tuned. More to come from Intel.
Yeah, I mean, we'll see how much value they can truly unlock, but it is a higher margin business, somewhere around the mid to low 60% versus much lower margins. Well, relatively speaking, for their other businesses like PC and data center.
All right, and I should say that Intel shares are just down a little bit. They were down about 1% at its lows, up 2% at its highs, right now down about 0.8%, so kind of bouncing around.
Yeah, the PE firms, including Francisco Partners, Silver Lake Management, are competing alongside with Lattice Semiconductor in a second round for Altera.
All right, Jake, gonna leave it there. Thank you so much. Jake Silverman, he's semiconductor analyst with our Bloomberg Intelligence team. All right, that's gonna do it for this hour of Bloomberg Business Week on radio, TV, YouTube, and Bloomberg Originals. If you're watching on television, the close is coming your way in just a moment. We've got a couple of big earnings coming our way.
Yeah, we got FedEx after the bell. We got Nike after the bell. So we got our Bloomberg Intelligence team standing by with their analysis as soon as those numbers cross. Also, how powerful is Elon Musk? That's something we're going to be discussing on our program in just a few minutes.
It's all ahead. This is Bloomberg.
is CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Cammie McCormick. Luigi Mangione is back in New York to face charges he murdered the CEO of United Healthcare. He now faces federal charges as well. Legal contributor Caroline Polisi.
The feds, the DOJ, specifically the Southern District of New York, has come out with a criminal complaint charging Mangione with 4 counts, 1 murder, obviously, and they're taking over from here on out. The FBI has swooped in. He's going to be arraigned first on the federal charges.
Fulton County DA Fani Willis has been removed from the Georgia election interference case against Donald Trump, and that leaves the case in doubt. CBS's Caitlin Huey-Burns is in West Palm Beach.
We can say without a doubt that this is a huge win for the Trump team. Because remember, this was the last remaining criminal case against Donald Trump. Since his election, those 2 federal cases have wound down.
On Capitol Hill, lawmakers are working to get another government funding bill together after the first plan fell apart. There is a Friday midnight deadline before a government shutdown. CBS's Torian Small is on Capitol Hill.
Not only would it impact agencies like TSA, so that can impact people's travel, it would also mean that non-essential federal workers could potentially see a furlough right before the holiday.
As millions of Americans begin their holiday travel, a fast-moving winter storm is making driving treacherous in parts of the upper Midwest. The storm is moving east, and Jonathan Gulliver with the Massachusetts Highway Department says they're ready for it.
If there is anything major that happens, we're going to be ready for it, and we don't see anything in the forecast for the holidays for this next 10 days. It's going to be pretty good.
The teenage girl who opened fire at her Madison, Wisconsin school this week had been texting with a California man who authorities say was planning his own mass shooting. Correspondent Ann Lee.
The alleged connection between the two comes as Madison's police chief told the Associated Press Wednesday they do not know if Monday's school attack was planned in advance.
Christopher Cruz reports all those drone sightings in New Jersey have led to new precautions in the skies.
Drones are now banned from flying over 22 areas of New Jersey where critical infrastructure is located at the request of federal security agencies.
Thousands of Amazon workers have walked off the job in the midst of the busy holiday buying season. Jason Miller is a professor of supply chain management.
So this strike, even though the number may seem large, is less than 1% of Amazon's workforce and a small number of facilities relative to the hundreds of large fulfillment centers Amazon has located in the U.S.
On Wall Street, the Dow is coming back after yesterday's losses, up 160. This is CBS.
OptimaTaxRelief.com.
It's never too early to develop healthy habits. Correspondent Michael George reports.
The age of 10 is a critical time for children to develop good heart health. A new study out of Harvard finds cardiovascular health starts to decline as early as age 10 due to diet, physical activity, and other factors, leading to high blood pressure, high cholesterol, and obesity. Doctors say it's critical to improve behaviors of kids early, as it can affect their cardiovascular health later in life.
Life expectancy in the U.S. jumped last year, and early data indicates there may be another smaller jump this year. Death rates are down for almost all leading causes, including COVID, heart disease, and drug overdoses. And a new study shows many people are aging more gracefully. Researchers looked at more than just disease, and they found many older adults have higher levels of mental and physical functions than previous generations did at the same age. I'm Cammie McCormick, CBS News.
This This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
All right, everybody, we've got 55 minutes to go before we wrap up this Thursday trade. Carol Masser along with Tim Stenivek live in our Bloomberg Interactive Broker Studio. And stocks, kind of a mellow trade, but certainly after yesterday's selling, maybe people want a bit of a mellow trade today.
I mean, I do feel like it's a mellow trade, but I also feel like it's masking some really big moves. Like you got, Micron down more than 16%. Yeah. Lamb Weston. Good point. Can we talk about French fries for a second?
Yeah, always can talk about French
Lamb
fries.
Weston down 22.7%.
Is that a decliner?
Oh, yeah.
How'd
you know?
It's the biggest decliner in the S&P 500.
Yeah.
I know how you roll.
You know how I roll. Talk French fries. But truly, truly looking at the indexes, I think it's masking some big moves. But we're going to talk to Abigail Doolittle about this.
And then Darden
Restaurants
is up 15%.
Is that one of your gainers?
That's how I roll.
All right, that's how she rolls. Hey, you know how Elon Musk rolls?
How does he roll?
He rolls like a very wealthy guy, and he's spending a lot of time in Washington, D.C. Just how powerful is he?
We are going to find out. We're going to get into it. The Institute for Democracy, Journalism, and Citizenship over at Syracuse University, sharing with us how it's quantified Elon's influence on politics. I've been thinking a lot about this. We've always known there's been money in politics, but it does feel like this takes it to another level.
And speaking of Elon, ARK Invest Kathy Wood stops by today, along with the CEO and co-founder of the fundraising platform Dealmaker.
Looking forward to what she has to say. And a huge day for earnings. You've got FedEx and Nike all reporting after the closing bell. Our Bloomberg Intelligence team going to be here with instant analysis, and we'll watch the stocks in the aftermarket.
All that and more coming up over the next 2 hours right here on Bloomberg Business Week. First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
All right, thank you very much indeed. We got 55 minutes to go until the closing bell, roughly 55, with the Dow, the S&P, and NASDAQ all advancing. S&P right now up 13. That is a gain of 0.2%. Dow Industrials up 132, up 0.3%. NASDAQ up 48. That is a gain of 0.2%. The NASDAQ 100 index down 0.1%, while the Russell 2000 index of small cap shares down 0.2%. 10-year 4.57%, with a 2-year currently yielding 4.31%. Gold up $12 the ounce, up 0.5%, $25.97, and West Texas Intermediate crude oil down 1%, $69.91 a barrel on WTI. Bitcoin now at 96,445. Bitcoin right now down by 4.4%. So the Dow, the S&P, NASDAQ all advancing. Yesterday, you recall, the S&P at this hour was down roughly 3%. Dana Dioria is co-chief investment officer at Envestnet, and on Bloomberg Open Interest this morning, she said the Fed is likely to shift course next year. And Dana Dioria of Envestnet again telling us that the Fed likely to see a shift next year. S&P up 13, up by 0.2%. Again after the bell. We had FedEx and Nike coming up after the close of trading. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. As Charlie just mentioned, U.S. stocks attempting to stage a recovery, traders recalibrating their expectations for the Federal Reserve's rate path. We're off our best levels of the day, but still higher by 0.2% on the S&P 500. We got with us Abigail Doolittle. She's Bloomberg News Markets correspondent. She joins us here in the Bloomberg Interactive Brokers studio. As I mentioned, it seems like there are some individual movers that are kind of making big moves today, but since they're not huge companies, we're not seeing that reflected in the indexes. How are you looking at the trade today?
That is a accurate way to look at the trade today, because as you were talking about, Lamb Weston down 22%, Micron down 16%, Darden up 15%, and yet you have the S&P 500 up about 0.2%. It is on above average volume. What stands out to me the most is more the macro picture. With the S&P 500 at today's highs, it had been up more than 1%. So yesterday, after that big, almost 3% sell-off, then traders really tried to scramble back. A lot of times back in the old days with the Fed, whatever way markets initially went, they then reversed. So that would have meant that today would be a big rebound rally. But we're really not seeing that. It's petering out. You have the S&P 500 back below its 50-day moving average. You have the Russell 2000 basically on its 100-day moving average. These are fancier, longer ways of saying the near-term dip buyers, they're not really present. It's not that they're completely out in the way that you would see in like a massive sell-off, but they're kind of cautious. And we're going into the end of the year. Above. It's above by 50. Yes. So so there's a lot of churning in a way.
It's like significantly above for the S&P 500.
Yeah, it is.
17% higher.
Yeah, it's sort of an interesting trade. You know, we're going into the last 2 weeks of a year that's been a fantastic year for people, you know, up more than 25%. So it makes sense to have this kind of a day where, you know, up 0.2%, down 0.2%, whatever it would happen to be today, you know, to the upside. That said, when we take a look at the weekly action, we're down more than 2% for the S&P 500 in the week, down for a second week in a row. The Russell 2000 this week down more than 5%, heading to a third down week. The question that we want to ask around this type of trade, are we seeing some sort of a trend shift that will last? If you were to take a look at the chart of the S&P 500, there's still a very nice uptrend over the last year. And one reason it's nice is because there was a pretty big pullback March, April, really massive pullback July, August, so it strengthens it. That means it's the stairs higher as opposed to the elevator. That said, up more than 25% after an up year last year, you know, there could be an escalator. So the thing to watch here is whether or not in the, you know, the next month to 2 months to 3 months, whether or not support holds.
Right, and which kind of gets us to a next story that we want to get into. You know, AI has been such a driver of the trade, but, you know, has that kind of, all of the low-hanging fruit kind of happened? And I guess we'll have to wait and see in 2025.
Well, that's a really interesting question, because NVIDIA down, you know, recently as a Broadcom was up, which speaks to, I think we were speaking about this before, more of a finite universe of dollars for that. So that could be a problem. And I think the biggest thing is it's going to take a while for President Trump's administration to implement policies. There could be choppy trade ahead of that and seeing exactly what they are and what they do.
And people have invested a lot, and sometimes you got to kind of wait for like it to start to take effect. Good stuff. Thank you. Abigail Doolittle, markets correspondent right here in at Bloomberg News in our Bloomberg Interactive Broker studio. So let's talk about kind of what's next for AI.
That low-hanging fruit, the perfect segue, because that's exactly how our next guest describes what the last 2 years have looked like when it comes to AI. We got with us Rachel Metz. She's Bloomberg News AI reporter. She writes about what the AI giants are doing now that that low-hanging fruit is gone, 2 years after the introduction of ChatGPT. She joins us from San Francisco. Check out Rachel's story on the Bloomberg Terminal and at Bloomberg.com/businessweek. Rachel, what is the tone that we've heard over the last few weeks, over the last few months from these AI giants? I mean, Anthropic, Google, Meta, OpenAI, about training these models and sort of what's next when it comes to this so-called AI revolution?
Well, it kind of depends who you ask, when you ask them, and how you ask them. But definitely in our reporting, we found that a number of companies, Anthropic, Google, and OpenAI, are having some challenges, I would say, in training their cutting-edge AI models. They are running out of data. They are not having the right kinds of data to train them to what they want them to be. And also these models cost so much money to make. So you really want to make sure that if you're putting a ton of money into something, that it's going to be good enough to be worth it, right? So they're seeing, as we put it, I think, diminishing returns in some cases with their most cutting-edge technology. And some people, such as Google CEO Sundar Pichai, have talked about this. And some other people have been, you know, a little bit quieter about it. Like you might see, or they say the opposite. Like you might see Sam Altman on social media saying, there is no wall. And I'm like, well, who said there was a wall exactly, huh?
I have to tell you, you saying this, I am obsessed with this story that our Linda Wan put out on December 13th. And I highly recommend, just like Rachel, read everything she writes. Check out this story, because it basically said AI wants more data, more chips, more power, more everything. But that concept of more data, I think we thought, oh, the world is awash in data. I give it tons of data every day. And yet there was this concept of actually really useful, smart data that helps AI kind of keep growing and get to the next level. I mean, that sounds like that could be kind of a supply-demand imbalance.
Yeah, I mean, it's important to keep in mind that not all data is created equal, and a lot of the data that is used to build these large language models, which is the kind of AI that powers chatbots like ChatGPT, it's a lot of it is coming from the internet, and it has been largely scraped at this point. So if you want to make bigger, better models, you need more and more data. So companies are starting to think about, well, where could we get more data from? And some of that could involve paying professionals, people with PhDs or other type of higher degrees to label data for like math models that can be really good at math or coding, things like that. You might look to people in the medical field, like a nurse, for instance, to label data related to medical professions, because you really want to have good data to train these models to be accurate and good at specific things going forward.
Here, why don't you take all this stuff so I won't have a job anymore? Why don't I teach you how to do my job so then
Is that sarcasm, Mr.
Yeah,
Stanovic?
that's just, I know I'm oversimplifying it, Rachel, but I see you're laughing, so my mission is accomplished.
I think there'll still be plenty for us to do.
Okay, good.
I'm so glad. I don't know. So how do you read this? Because I do feel like it has been nothing but, not even a marathon. It's been just a fast race the last 1.5 years, 2 years in terms of the AI spend ramping up. It just feels like anything that came, in terms of AI or when we do earnings, right, we wanted to see, is the AI spending there, and so on and so forth. But it does feel like a reminder that all of this is going to take time. How do you think about this cycle?
I think that what you said at the end there is really spot on. It is going to take time. And also, as we've seen in other industries, sometimes the pace of innovation doesn't always, it's not always the same. It goes in fits and starts. Sometimes things are really fast. Sometimes things even seem to go backwards a little bit. I spoke for this latest story, I spoke with Jonathan Frankel, who is a scientist, and he works at
Databricks.
At Databricks. Yeah. And he said something that I thought was really spot on, and I've actually heard this from a couple people, that we should look to the chip industry. And, the chip industry, we've seen different innovations over time, and sometimes directions change depending on where's the best way to innovate. And that seems to be what we're seeing with AI. And that's what I would expect to see going forward, is people trying different things. Sometimes they work, sometimes they don't. And sometimes things go fast, and sometimes they go a little slower.
Hey, Rachel, really quickly, 10, 15 seconds. I mean, might 2025 be that? Like, I don't know, take a breath. Slow your roll, everybody. When it comes to AI, might that be the 2025 year, or who knows?
I don't think so, actually.
Okay.
I mean, that would be really nice. It would be relaxing for the news cycle, but I think that we're going to see a lot of people working on so-called AI agents. This would be AI software that can perform more complicated tasks with not much help from humans, and some other things that we're going to see companies doing. I think they're really pushing ahead, and we have to remember a lot of these companies still have lots of money to burn, so they're going to keep plugging away.
Well, good. That means we get to continue talking to you. So love. Rachel Metz, Bloomberg News AI reporter. Check her out on the Bloomberg Terminal and, of course, at Bloomberg.com.
Up next, a check on the health of the consumer with the CEO of VantageScore. This is Bloomberg.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. 39 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ, and yes, the NASDAQ 100 index all advancing. S&P right now up 19, up by 0.3%. Yesterday we had the S&P selling off by 3%. Stocks, though, attempting to stage a recovery. Traders recalibrating their expectations for the Fed's interest rate path. The Dow up 196, up 0.5%. NASDAQ higher by 0.4%. The Russell 2000 index, though, does remain lower. It is down now by just about 0.1%. 10-year 4.57% with a 2-year yielding 4.31%. Gold up $13 the ounce, up 0.5%. Crude down 1%, $69.91 a barrel. Continuing to keep an eye on Bitcoin, now down by 4% and below 97,000. Bitcoin now 96,909 on Bitcoin. Coming up after the close of trading, closely watched earnings out of Nike and FedEx. FedEx is facing questions on plans for its struggling freight segment, including labor issues and geopolitical tensions. And Nike's CEO in his first earnings call will discuss holiday sales and product pipeline. Adrienne Yee is a senior analyst at Barclays Capital.
We are actually looking for a miss, but the title of our preview note was that this is the first earnings call where you're going to have the new CEO, Elliott Hill, who had started kind of mid-quarter, sort of October 14th was his first day on the job. But the fact of the matter is there is a lot of heavy lifting to do here. The DTC, the direct-to-consumer, the digital channel, is showing signs of tremendous promotionality, and we've heard that from their channel partners as well as our own checks.
Adrienne Yee of Barclays. Nike up now by 0.4%. FedEx ahead of earnings up 0.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. You are listening and watching Bloomberg Business Week. It is brought to you by Audi. Visit your tri-state Audi dealer today and get behind the wheel of the Audi model you've always wanted.
Okay, we heard a lot from Fed Chair Jay Powell yesterday on the economy, the consumer, and how the Fed is thinking about rates. Here's just a couple of things that he said. Quote, growth of consumer spending has remained resilient. Check. Quote, the economy is strong overall and has made significant progress toward our goals over the past 2 years.
Check.
Check. Quote, we think the economy is in a really good place and we think policy is in a really good place.
Check, check.
Okay, so that's what we heard.
Sounds pretty good.
From the Fed. It does sound pretty good.
Right?
I mean, yesterday's market reaction notwithstanding.
Yeah, exactly.
For a check on how the consumer is doing, let's bring back Silvio Tavares, CEO at the Credit Data and Credit Risk Analytics firm VantageScore. It's a joint venture of Experian, Equifax, and TransUnion. Silvio joins us from San Francisco. Silvio, I wanted to talk to you because you have so much good data about consumer health. How would you characterize the consumer right now?
Well, Chairman Powell was spot on. The consumer's healthy, and that's good news. That's good news for us as consumers. It's good news for the economy. The challenge that we have seen and the big change is that inflation is more stubborn than anticipated. And that's the big thing that changed. And we heard from Chairman Powell, they're going to keep rates higher for longer. And that means less bank lending and probably less consumer credit utilization as well. Not great for merchants.
Hey, we had Mike McKee on earlier, but he made the point yesterday during his turn to speak that we haven't seen rates come down.
Consumer rates,
Consumer rates, yeah, excuse me. Thank you, Carol. Consumer rates come down when we're talking mortgages, when we're talking credit cards, and the like. How are you looking at that over at VantageScore and what that means for your, well, I was going to say your clients, your customers, but kind of like we're all, you have a view of all of us, whether we know it or not.
Yes, very much so. As you mentioned, VantageScore is the largest national credit scoring company, and we take data from TransUnion, Experian, and Equifax to assess the health of the consumer. And lower interest rates, the cut was anticipated. The cut that happened this week was anticipated. And if you look back at November, basically banks anticipated it, and they actually opened up more credit accounts. New credit card accounts in particular were up modestly in November. But consumers only spent slightly more. Credit card balances were up a little bit, about $30 November compared to October, and about $200 year over year. And so overall, the interest rates and the expected cut tended to increase new credit accounts and increase spending a little bit, but not a lot. And so that's not necessarily bad news. In some ways, it's good news. Consumers are being disciplined about their credit utilization, not getting in over their heads. And banks are also somewhat modestly increasing credit lines, but still being cautious. And we're going to expect to see that continue into next year.
Yeah, I'm just listening to you, and I am curious, like the number of accounts being opened, is that a good sign because people can do it and they get approval? Is it a bad sign because people are opening up new accounts so that they can find new places to spend and create bigger credit? So help us understand the data that you get. You get so much in real time, it feels like. What are the words that you use to describe the consumer credit picture right now?
Well, I would say it's healthy. You know, a low credit score for a consumer is 300. The maximum possible credit score is Vantage score 850. And the average consumer was 702 through the end of November. And that's, you know, the earnest start of the holiday spending season. So consumers are credit healthy. And we're seeing modest increases in consumer spending, and we're also seeing modest increases in consumer lending. So overall, steady as she goes, for sure. The challenge is, as you look to next year, the news we got this week from the Fed is they anticipate inflation to be much more a significant issue than before the election. And so that's the main area for concern as we go forward. Is the Fed going to be able to tame interest rates? Because if those interest rates, those inflation rates get out of control, they're not going to be able to cut interest rates as much and as aggressively as they signaled to us before.
You mentioned 702 for the average Vantage score, 4.0 credit score. Carol and I just both saying to each other, that seems high, given that the highest you could get is 850. Yeah, is that high? That seems high for average.
You're absolutely right, and it's high by historical standards. And what that tells you is consumers overall are actually very credit healthy. They're managing their credit cards well. They're not getting in over their head on personal loans or their mortgage, and that's a really good thing. And I think that's a bit of what's been lost as we saw the wild swings in the stock market since the Fed announced its 0.25% cut. What's lost in all of that market swooning is the fact that overall, the economy is doing very well and consumers are actually doing very well. And the key problem that the economy is facing is making sure that inflation doesn't get out of control. That's obviously, that reaction to inflation is what impacted the election, and it's the main thing that all the new members of Congress are thinking about. It's what the president-elect is thinking about, and it's certainly what the Fed is focused on, is just managing that inflation so it doesn't get all out of control. But the reality is we got a great economy right now.
Silvio, tell us, though, what do you know about the demographics of the folks that, from the data that you get and the credit scores that are issued? Like, what do we know about that pool of people? Because I also do wonder, and something Tim and I talk a lot about, folks at Bloomberg talk a lot about, is the underbanked, you know, folks that maybe can't get that credit card, so they're not even in, you know, that average score statistical bunch, if you will. So give us an idea of what you know about the demographics of your business and the people that you basically rank.
Well, that's one of the advantages of the Vantage score. We actually include a lot of people that traditionally were left out of credit scores. We actually include about 30 million more consumers. Many of those consumers are folks that historically didn't get a credit score, but we're able to score them using our advanced techniques. And, you know, if you think about the average consumer overall, they are, in fact, doing better than they were a year ago. And they're actually using credit slightly more than they were a year ago. And that's the high end as well as the low end consumer when they can't access that credit. So we're seeing a pretty uniform picture. Overall, consumers doing modestly better than they were a year ago. The key, though, as we look into the new year, what we're expecting is the Fed is going to keep interest rates higher for longer. And what that's going to mean is fewer consumers are going to get new credit accounts, and that's going to disproportionately impact the low end. But it also means that the high-end consumer, they're going to be more reluctant to use credit.
Hey, I'm curious about buy now, pay later and those types of firms. The sort of like instant credit that's offered at checkout at places. Are they using VantageScore?
Absolutely. Many of those firms use a credit score to manage the access to new BNPL accounts. However, many of those firms, buy now, pay later companies, they don't provide data on the performance of those loans. And that is a blind spot for the industry that we're working on, because as that has grown, the utilization of buy now, pay later, you want to get the data on whether people are actually paying up in 3 or 4 installments.
Are they?
Well, it's tough to tell. It's tough to tell. What we can see is that overall, delinquencies, that's the industry jargon for whether people pay their credit card loans on time. Those delinquencies are actually pretty good. And in fact, they're better than the pre-pandemic averages. And they're holding steady. We saw that in the most recent November credit gauge. And what that shows is, again, consumers remain credit healthy. We're not seeing a significant deterioration in delinquencies. And that's actually very good news for the economy.
Hey, when it starts to go bad, though, does it all of a sudden turn quickly? Like, do you guys get indications that, all right, we got some trouble here when it comes to consumer credit? Tell us about kind of that ability to kind of forecast. Because I know in some indicators, when they start to go bad, they go bad really quickly, and then they just drop off.
Well, and we've certainly seen that. There's been a period of unprecedented credit volatility over the last 2 to 3 years. Things do change quite rapidly. And it's one of the reasons why we are seeing our customers, banks, our stakeholders in Congress and at the Federal Reserve, we're seeing them turn to more high-frequency data. You've got to check what's happening in the market more regularly. It's one of the reasons that VantageScore was an industry leader in publishing insights on a monthly basis. We call that VantageScore Credit Gauge, and in fact, we're publishing that tomorrow morning. The data I'm sharing with you is an exclusive that we provided to Bloomberg in advance. But the reality is, if you're a bank, if you are a policymaker, you got to be checking more regularly, because things move quickly. And I actually anticipate that's going to accelerate. Things are going to move even more quickly as we head into 2025. New administration, new regulators, new policymakers, all of that is going to bring more
Just a few things going on in the new year, no doubt about it. Silvio, thank you so much. Have a good holiday. Happy New Year. Thank you so much. Have a good holiday. Happy New Year. Silvio Tavares, he's Chief Executive Officer of VantageScore, joining us on this Thursday from San Francisco.
Let's take a look at the markets as we do get just about 25 minutes away from the close. We're off our best levels of the day on the S&P 500, down 0.2%. The Dow finally up, Carol.
Makes you happy, huh?
Longest winning streak well, it was longest losing streak as of yesterday in more than 50 years.
Interesting market moves. We just talked about consumer credit. Now we're going to get into kind of private credit and what's going on there.
Ooh.
See what I did there?
Okay, I see what you did there.
Kind of a little lame. I'm having some troubles today.
No, you're doing okay. I believe in you.
This is Bloomberg Business Week.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. Developing story out of Washington. House Republicans say they have reached a deal to avert a U.S. government shutdown with a vote that could come as soon as tonight. Now, let's head right over to the First Word breaking news desk for today's afternoon call. And here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks are in the green, but off their opening highs, with the Dow currently up 182 points. The S&Ps are higher by 17, and NASDAQ rises by 0.3%. The U.S. 10 yield is now at 4.57%. Gold is in the green, oil is in the red, but Bitcoin, that's down by 5%. Among the main 11 S&P sectors, leaders were utilities and financials. Real estate and materials were under pressure, and leaders to the upside in the Dow, Boeing and American Express, while UNH and Home Depot led to the downside. After earnings, Micron plunged as much as 19%. And in other news, AGCO sees North American retail demand down 25% in 2025. Wrapping things up, Nike and FedEx report after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, to hear live breaking news over your Bloomberg-type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, tick-tock, everyone. Almost 20 minutes left to go until we wrap up the trading day on this Thursday. And you've got stocks bouncing around. We are green across the screen, although call the NASDAQ 100 pretty much unchanged, just up a couple of points. You just heard Charlie and Bill Maloney just breaking down the trade. But we're off our best levels of the session, but still up about 0.4% on the S&P. And as I said, the NASDAQ 100 is flat. I know you're going to go to the Dow. It's up about 0.5%.
Oh, well, then, okay.
What?
So now I got nothing.
Sorry. Took it from you.
I got nothing.
Sorry.
But we're talking this week about the losing streak that the Dow has had.
Yeah.
I mean, we're talking one that was like decades until today.
All right. So one thing.
You don't care. She doesn't care. She doesn't care. She doesn't care about the Dow.
I want to talk about private credit because we have a great guest back with us, Anna Arsov. She's Global Head of Private Credit and Financial Institutions over at Moody's. And Anna, I keep thinking about, I don't know, private credit, everybody's all in. Firms, private credit firms are expanding beyond corporate lending to finance areas like auto loans, residential mortgages, chip manufacturing, data centers, excuse me. So we're talking about a potential market size of $40 trillion. Again, it's a market that many would argue there isn't a lot of transparency. Are there checks and balances as you see it in the private credit world?
First, thanks for having me. I really appreciate, obviously, being a repeated guest. And yes, we are focused on the same point that you're raising. We don't think that there is equal level of transparency in all of the aspects of private credit. And namely, I would probably separate the BDC portfolio, which is business development companies. These are closed-end funds focused on investing in middle market loans that we rate with a lot of good granular disclosure publicly. These are mostly public trading vehicles. There's some privately traded, but really most of them are public vehicles with great disclosure. But that market is roughly around $300 billion, pretty small part of what we estimate $3 trillion north of market growing into the next couple of years. So again, I would say that disclosure is still. It's improving, but not where it needs to be for such a growing market, and particularly growing market that wants to tap retail money.
Where do you think it needs to be? I mean, like, what would make you say, okay, now I'm comfortable with their view that they want retail money? There's enough disclosure there. Like, what do they need to do?
Well, I think that we don't have aligned rules, for example, on valuations of private companies. Every fund can choose its own governance around valuations, which is a very important driver into how these, first of all, portfolio companies are estimated, and particularly the private loans that lend to these portfolio companies, which is usually on a loan-to-value basis as well. So again, valuations is an area that we would like to see more coherence and focus on. transparency, same way of discussing, for example, defaults. In the public market, we have a very clear view what a default is for a loan, not necessarily in the private markets. There a loan can be restructured multiple times without necessarily occurring a default ever. So again, there's some alignment between the public and private markets on the credit side that needs to happen in order for this market, I feel, to be fully institutionalized.
I do wonder though, so how do you go through, the supply chain that is private credit? I mean, is there some area, I don't know, I feel like the traditional big banks are looking to get, kind of more involved in it. So how do you go about, providing kind of the legwork, the framework, the due diligence, and again, in an area where we don't have a lot of oversight or a lot of information?
Look, one of the areas that we've been also focused on is looking at the regulated sector that at the end of the day either invests in, like the insurance industry, or lends to, which is the banking industry. So private credit could not really grow to the level it grows without one of the major investing classes are regulated industries, which is insurance, and without the leverage provided by the banks. So one way to improve that is for those regulators of those sectors to really have a sense of kind of the risks that they provision to the private credit market. And actually, the banking regulators in the U.S. are making a very good stride. Starting in January of this year, the banks will be mandated to, for example, provide more granularity about lending into this this market and the non-bank financials market in general, with better granularity. What is private credit? What is private equity, etc. So I think that will be a move forward. The insurance industry is obviously very heavily invested, particularly in the U.S. We estimate around 30% of the insurance industry is in some kind of way of alternatives, if you will, and that's going to continue growing based on CIO surveys. So I think both of those industries have a very high vested interest in their regulators to help disclosures in the private markets.
Anna, hang on a second. We just want to do an update on the possibility of a U.S. government shutdown, and we do have a story out by our Bloomberg government team. House Republicans say they've reached a deal to avert a U.S. government shutdown with a vote as soon as this evening. Representative Tom Cole, he's the chairman of the Powerful Appropriations Committee, would not disclose details of the plan as he emerged from a meeting this afternoon in House Speaker Mike Johnson's office. He also didn't say whether congressional Democrats or the White House had agreed to it.
Look, Trump late Wednesday afternoon demanded that Johnson abandon a deal he previously worked out with Democratic congressional leaders to avoid a government shutdown before the holidays. Government funding will lapse Friday night without congressional action. Cole said he anticipates a House vote on Thursday evening. We'll see what the president-elect has to say about this one.
Absolutely. We did see some buying, I felt like, in the market a little bit earlier, but it's kind of bounced back down. So I was just curious to see if there was any kind of connection with some of this news coming out of D.C. We will continue to monitor. Getting back to Anna Arsov, Global Head of Private Credit and Financial Institutions at Moody's. Anna, from what you know about the private credit world, do you think it is wise that we look to open this up to more and more retail investors, accredited or otherwise?
Look, depends on the format. And actually, as a matter of fact, the business development companies are largely a retail product. But as I noted, those are, they're funded primarily, at least the rated universe, which we rate the largest, 30 plus vehicles in the space. They actually have a pretty good disclosures publicly to the public on a loan level granularity performance, and also to the ones who actually provide for liquidity on a quarterly basis. We do in-depth analysis in terms of how much liquidity they have to have provision for that liquidity of, let's say, maximum 20% a year, 5% a quarter. So that you can plan for that, because that vehicle, again, doesn't have an ability to necessarily withdraw the money from a client immediately overnight, like a deposit or like in the ETF market. On the other hand, the ETF market has daily liquidity. So there, the mismatch of that illiquid underlying asset class with a daily liquidity is something that is of our concern.
Which, of course, Carol, you're supposed to get compensated for when it comes to returns.
Right.
If you can't have excess.
Right. Your assumption is that those returns are going to be,
better because
better
they're
than
locked
the
up.
overall market, right? Because you're kind of leaving your money there. I don't know. A lot to be known, and we'll see what 2025 holds when it comes to private credit. But it certainly has consumed our conversation on the investment side of things, really for at least the last couple of years, if not longer. Anna Arsov, thank you so much. Happy holidays. Global Head of Private Credit and Financial Institutions over at Moody's, joining us on this Thursday. Just looking at the markets, we're definitely off our best levels of the session. So what does that mean? We are just up about 13 points on the S&P 500, so up just barely. Dow up about 0.4%, and you've got the NASDAQ 100 now down about 0.25%. We're driving to the close. This is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stennebeck on Bloomberg Radio and Television.
All right, everybody, just under 7 minutes to go until we wrap up this trading day. We're going to head over to our television colleagues and count it down to the close. Also break down some earnings. We've got Nike and FedEx, so that's important. But what's also important to investors is what we just talked about, Tim just teasing it. House Republicans say that they have reached a deal to avert a U.S. government shutdown with a vote on a new package plan for today after President-elect Donald Trump pressured GOP lawmakers to abandon an earlier bipartisan agreement. So there's been some back and forth, but this would be interesting. And now it's like, well, what kind of package?
Yeah, so we
if
don't
indeed this is happening.
The devil's in the details, right?
Always,
as we know. Representative Tom Cole, who's the chairman of the Powerful Appropriations Committee, would not disclose the details of the plan as he emerged from a Thursday afternoon meeting in House Speaker Mike Johnson's office. He also didn't say whether Trump, congressional Democrats, or the White House had agreed to the latest funding package. Also, what about Elon Musk?
You mean the existing White House administration?
And what about yeah, exactly.
Just saying.
What about Elon Musk?
I don't know. I would think Republicans wouldn't come out and say something unless they had some certainty. But I guess, as you said, the devil's in the details. We don't know. Plan A was, 1,500 pages in terms of a spending plan, a lot of moving parts to it, and including, a cost of living increase for members of Congress.
$100 billion in disaster aid. pay raise for lawmakers. Elon Musk was not wild about that.
Yeah.
Speaking of Musk, he had savaged Johnson's earlier deal in a day-long series of social media posts. That was yesterday. He roused his followers against the bill and declared that any lawmaker who supported it should be defeated in the next election.
Yeah, I mean, that's really interesting. And the president-elect also said he wanted to see a shutdown if the debt limit isn't extended or ended entirely. So you do wonder, like, is this potentially part of this? So I don't know. Again, as we say, we don't have all these details, but it does look like it's moving along. I think a lot of us were wondering, is this going to be something that carries out over into the weekend? We've got, the Christmas holiday. We've got Hanukkah coming up. We've got a lot of holidays coming up where people normally want to head to their families. So you do wonder what kind of pressure that puts on getting something
What do
done.
lawmakers' kids get in their stockings? Like shreds of the spending bill that didn't work because their parents had no time to go out and buy anything?
Look what I got for you.
Yeah.
Oh, wait, this is what we were going to do for X community in the United States.
I will say, I mean...
What?
They're not always... They do get a lot of time off, Carol.
Okay.
Lawmakers.
I know.
So
I know.
Working toward the holidays.
Got to get it done.
Close. You got to get it done.
Can't go home until you get it done.
We'll
That's
see.
kind of what we do. We got to get it done before we go home.
We'll see. They've definitely have not gotten it done before. That has happened in the past.
What's fascinating is a lot of this has been playing out in social media. You talk about Elon Musk having a thing. Again, we've seen from the president-elect in terms of if you don't agree with me, is your job maybe questionable moving forward. So there's a lot that has been at play here, but we will see whether or not we get some kind of deal done tonight and to avert that government shutdown, which is never a good thing, certainly for any government.
There was an interesting endorsement from Democratic Senator Elizabeth Warren, who posted on X that Congress should end the debt limit, agreeing with Trump. Other Democrats, though, including House Minority Leader Hakeem Jeffries, see the move as a ploy by Trump to advance his tax agenda next year to the benefit of corporations and wealthy Americans.
The thing that kills me is it's Congress that agrees on these spending plans, and then it's like, well, wait a minute, we have questions about it, right? And we kind of keep running up against this. So I don't know what the answer is, so that we don't have this ongoing problem. But we also have debt that needs to be dealt with.
The answer to this is a preview of things to come January 20th next year, and even earlier when a new Congress takes shape.
All right, folks, we're going to be watching certainly the Bloomberg for any headlines that cross on this and let you know whether or not we are going to see some kind of resolution this evening. But in the meantime, we're keeping a watch on the markets after a day, that Fed decision yesterday, a lot of selling, broad-based selling. Today, a bit more muted. Right now, you've got the S&P 500 just down about 2 points, so call it unchanged on the day. The Dow Jones Industrial Average, it too is just up about 0.08%. You've got the NASDAQ 100 down about 0.4%. So we'll see what happens, but it does feel like things are slowing down just a little bit. Don't forget, we've got FedEx and Nike earnings. We'll be breaking them down. Over to our TV colleagues we go. The closing bell starts right now.
All of your market action with our global simulcast. That simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you to that closing bell, a global simulcast. It starts right now. Scarlett Fu here in the TV studio, Carol Masser in the radio booth, Tim Stenovic also by her side as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A day where we're seeing stocks kind of extend to a certain extent, Carol, that sell-off from yesterday.
Yeah, I mean, it just feels like it's kind of running out of steam. Any kind of momentum that we saw earlier, very mellow. Although Tim and I have been talking a lot about that despite the kind of muted moves right now in the major averages, you look at some specific names and you've got some big rallies and some big declines.
Yeah, like Micron Technology, Lamb Weston, just a preview for some of the decliners that I'm looking at that are making outsized moves. It does look like, though, that if the Dow does finish in the green today, I know this is a huge deal for you guys.
Yeah.
It could snap a 10-day losing streak going back to 1974. It was the longest.
You know, I look at today's economic data. I can't remember the last time I paid this much attention to the third revision of a GDP report for the last quarter, but it really kind of reinforces what the Federal Reserve did yesterday.
Yeah, I mean, growth actually moved higher. Business investment was really good. Personal spending was really good. Mike McKee made this point that Scott Bessent's plan for 3% growth based on third quarter GDP, he'd have to actually reduce growth to get to his level that he's targeting.
And that's a good thing, right? I mean, for markets, that should be a good thing. Of course, they're all concerned that growth might actually mean, well, extra inflation. And we saw the inflation numbers come up in that report as well.
Yeah, taking a look there, it just looked like a really sad close, you guys. We're like limping there. Triple witching tomorrow.
All right, we got to get these folks clapping a little bit harder here. I mean, you got one job when you're up there, folks. Clap and cheer. Look at the Santas. They got it.
That's okay.
All right, a ho, ho, ho to everyone down there at the NASDAQ. The NASDAQ composite, though, not much cheer on the day. Down about 23 points or 0.1%. The S&P down by roughly about 5 points here. We'll just kind of call that unchanged, not even quite 0.1% there. And we should point out the Dow Jones Industrial Average, as Tim was just pointing out here, rising for the first time in 11 sessions, up 16 points, assuming those numbers hold. That's basically a fraction of 0.1%. And the Russell 2000 down in the red, once again, down 0.5%.
Yeah, Santa a little mellow. Even Bitcoin's down today, down about 4.6%, Scarlett. But if you look at the S&P 500, you've got most names, some up, but most of them more than 300 to the downside.
Yeah, and leading on the downside, when you look at the sector performances, our real estate investment trust losing about 1.7%. Materials and energy also down about 1% apiece. On the flip side, utilities are gaining ground, 0.5%, financials and technology, but those gains are fairly modest, with tech only up by 0.2%.
All right, guys, to the individual gainers. Darden Restaurants, your number one gainer in the S&P 500, up 18% at its highs, finishing the day just shy of a 15% gain. Shares rallying to a record after the owner, Olive Garden and so on, raising full-year sales outlook, topping estimates, suggesting casual diners are eating out more, which is kind of interesting. Stock gained as much as I said, about 18% here. So very, very big jump, most, I think, in about 4 or so years. Soho House, that one also soaring in a big way, up 65% at its highs, soaring the most ever, finishing with about a 49% gain after saying it received an offer from a new third-party consortium to buy the company for $9 a share. Stock closing at $7 and change. That $9 a share, though, is a more than 80% premium to where the stock closed yesterday. So quite an offer. The offer supported by the company's executive chair and controlling shareholder, Ron Burkle, and also hit the private equity investment firm that he helms. So that was certainly a standout. And Marvell Technologies, this one was up 3.7% in today's session. This is your number one gainer in the NASDAQ 100. Stock getting a boost from the analyst community. It will become one of the big winners from the rising demand from AI semiconductors, that from Raymond James. They raised their price target to 130 from 120 and reaffirmed their outperform rating on the stock. Stock closing at 109 and change.
All right, you got the gainers, Carol.
Wait,
Sorry, guys, we
before.
need to get to FedEx.
Yeah, go ahead. Go to it.
FedEx, the earnings aren't out just yet, but they are announcing their intent to actually split up two of their key units here. They're going to separate FedEx Freight and create a new two industry-leading public companies. So this is a full spinoff here of the two units here. Again, we talk about these units that were actually brought together not that long ago. The board now announcing here that they plan to separate FedEx into two publicly traded companies. One will be called FedEx and the other will be called FedEx Freight, which will allow them to continue to pursue their growth strategies independently and allow for more customized operational execution. So the real headline here, guys, is FedEx, a singular company, will now become two.
And Bloomberg Intelligence says that unit itself could be estimated to be worth between $31 and $33 billion. We'll get to those numbers more in just a moment. Another headline here, President-elect Donald Trump backing latest GOP short-term government funding plan. He says the GOP deal includes extending the debt limit to January 2027.
All right, and on the heels of that FedEx announcement that it is spinning off its freight business, we also get the numbers for the last fiscal quarter. Second quarter adjusted EPS $4.05. Analysts were looking for $3.98, so that is a beat. $22 billion comes in shy of the expected average analyst estimate of $22.15 billion. Operating margin 6.3% is higher than the anticipated 6.06%, and adjusted operating income $1.38 billion, just slightly higher than the expected estimate as well. In terms of the full year outlook, adjusted EPS of $19 to $20. Previously, FedEx had anticipated $20 to $21. Full year adjusted EPS, again, higher than what it had adjusted EPS $19 to $20. Previously, it saw $20 to $21, so that is a paring back of that full-year adjusted EPS.
Okay, shares higher right now by a little over 10%, but back to some of the other big news out of FedEx, the fact that the company says they're going to separate into freight and separate FedEx Freight, creating two industry-leading public companies. Here's what the company says about the strategic rationale here. They say enhanced operational focus and strategic execution. They say distinct and compelling investment profiles. They have strong balance sheet and capital allocation optionality, and a shared brand, because they say the FedEx brand represents speed, reliability, and trust, and the values will extend across both businesses, with the new company continuing to operate under the FedEx Freight name.
Got to say, there's more commentary from the company's CEO, and this is coming from Raj Subramanian. He says the Federal Express segment delivered operating profit growth despite several headwinds, including the continued weak U.S. domestic demand environment, as well as the expiration of our U.S. Postal Service contract. And then the company's executive VP and Chief Financial Officer, John Dietrich, he said, I remain confident FedEx will continue to grow earnings this year despite the challenging demand environment as we focus on transforming operations and improving revenue quality. But again, I'm just looking at that, Romain, and just talking about kind of the headwinds that are out there for this company.
And it's kind of interesting because we talk about how these units were, as combined, were sort of the strength of FedEx, at least relative to its closest competitors like a UPS and a DHL. But the idea that this seems to be more about cost savings, at least on the surface, is how I'm reading it here. It's interesting that that's sort of the tack they're taking here. They're also saying that it's going to take about 18 months for this to play out here. They have advisors, but I'm also curious to see who's going to lead these companies. Like, I assume Raj is going to stay behind at the big FedEx, and they'll find someone new for FedEx Freight.
Well, I don't know. I mean, their freight business also houses the less than truckload part of their business. And all told, they say that that part of the business was $9.4 billion in revenue in fiscal 2024. But that's really the big news. Plus, you get a buyback now of stock from FedEx as well.
Yeah, not too shabby. Stock's up about 11% at this point. We're going to be talking about this one certainly into the Friday trade. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place, tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
It is Bloomberg Business Week. That's Carol Masser. I'm Tim Stenivek. Got to get that right here. A lot of news happening, though, in the after hours. The FedEx news is huge. Shares are surging after the company announced its latest results, and also saying that it's going to separate into two separate publicly traded companies. We also learned that President-elect Donald Trump has backed the latest House Republican package to avoid a U.S. government shutdown. He said this in a post on Truth Social. Here's what he wrote, quote, all Republicans, even the Democrats, should do what is best for our country and vote yes on this bill tonight.
I mean, I kind of want to see what's in the bill, like the devil's in the details, as we like to say. All right, so we're looking for more information on that.
Let's see what Margaret Tolliver has to say about this. She's director of the Institute for Democracy, Journalism, and Citizenship at Syracuse University. She's also former senior White House correspondent for Bloomberg News. Margaret joins us from Washington. Margaret, I know that you guys have this big report out about Elon Musk's influence. We're going to talk about that in just a minute, because you can't talk about funding and the debt limit without talking about Elon Musk, especially what he's done in recent days. But what's your view on the way that the president-elect has driven the conversation about this weeks before he even takes office?
Yeah, well, first of all, it is great to be back with you guys. Carol and Tim, thank you for having me back on such a crazy, busy day with the three-ring circus. It's funny because it really doesn't matter on some level who the president is and who's in control of Congress. You can almost always count on a cliffhanger and chaos, like, the week before everyone's supposed to break for the holidays. This has been no exception, but it's been very interesting to see President-elect Trump walk his own speaker, Mike Johnson, right to the edge of sort of, let's say extreme instability and risk of getting tossed over the edge by his own party, and then blow up the carefully negotiated earlier deal and demand he get sort of a long runway on the debt ceiling, maybe abolish it, or maybe just give him a couple of years running room into the, at least through the first midterms of his presidency, and that's what he wants. You've got several Republicans who don't want that because they're fiscal conservatives, And you have Democrats who don't want it because they think it would just hugely empower Trump with no accountability and that they would end up regretting doing it. So a lot of drama thrust into, the last 48 hours or so. And to your point, Elon Musk has been at the center of it. I think months ago, back in the quaint days of the summer when J.D. Vance was rolled out as Trump's running mate, everyone thought, well, if he becomes the vice president-elect, we'll really see a Trump and J.D. Vance partnership. But it's really been a Trump and Elon Musk partnership with J.D. Vance kind of running up to the hill from time to time. But it has been Musk with the soapbox and the leverage and the ammunition.
Margaret, I always think about this. Congress works for we, you, me, Tim, like the American people. And so are we getting something here that's good for the American public?
These end-of-year negotiations to avert a government shutdown are, by their very nature, no matter how many elements get sussed out, there are always elements that slip under the rug or between page 1000 and 1010.
Right.
So it's this is nothing new, but it's not one of the most sunlit filled rooms in government is all the stuff that gets crammed into a bill. People vote in it, they haven't read it yet. It creates a lot of consternation for members of Congress too, and then once it passes, it's passed. But these budget stopgaps, they really don't resolve things for 2 years at a time. Typically, they resolve things for a few months at a time. And that you've seen part of that is what the former and President-elect Trump wants to avoid is he doesn't want to have to keep dealing with these battles in the early months of his presidency while he's trying to do other things. But the partisan lines are so close and there are so many fractures within the Republican caucus itself that it's very hard to get lasting long-term agreements. And it's very hard to get transparency in the final hours when they're trying to jam through a compromise.
You mentioned Elon Musk. So that's where I want to go now, because according to the New York Times, Musk has made more than 150 posts just in a short period of time agitating for a government shutdown. That happened yesterday, is when he was making those posts. He spent hundreds of millions of dollars helping to elect Donald Trump. This morning, Rand Paul, Republican senator of Kentucky, tweeted that perhaps Elon Musk should be Speaker of the House. No question Elon is influential in Washington these days, but I do wonder how influential he is, Margaret. And you tried to actually quantify that at the Institute for Democracy, Journalism, and Citizenship at Syracuse University. How do you measure it?
We've had this really cool year-long project. In fact, the last time I was on with you, we talked about it a little bit, called the Election Graph Project. We were very lucky to receive a research grant from a company called Neo4j that develops graph technology that's basically a technical way of saying their software lets you see both hidden connections between seemingly disconnected people and also commonalities in text and video. And we use their technology, and my colleague Jenny Stromer-Galley built a research team at our Institute for Democracy, Journalism, and Citizenship to try to look for misinformation and basically patterns in the spread of information around ads on Meta platforms related to the presidential campaign. And I know it sounds super specific, but you have to draw some boundaries around it. Just looking at ads on Meta, we found more than 6 billion with a B ad impressions from the campaigns, just the Harris and Biden and Trump campaigns. Then another 5 billion impressions from outside groups. And among these outside groups that we looked at, we tried to understand these dark money groups that got money from Elon Musk, but either had no accountability or really no accountability until after the election. How impactful were they? We found that there were more than $6 million spent in negative ads just from those groups that were backed by Musk that were doing a lot of the work to undercut Kamala Harris in those closing days. $6 million doesn't buy you a whole lot on linear TV. $6 million buys you a lot on social media platforms in terms of ad impressions, which are basically just views. How many times did people see an image or see the text of these ads coming through on their screens?
In that period of time, Elon Musk has bought, he owned it, over the last year, but he bought X a couple years ago, but he's transformed it over the last year into something that's completely different, I think many people would say, than it was before. Certainly, it's his preferred method of communication. How do you measure his influence just using that social platform?
Right. I mean, it's a fantastic question. Again, this election graph project with the IDJC and Neo4j looked at meta platforms, and part of the reason why is because the regulatory structure does not compel all the social media platforms to give researchers access to this information. So it's really hard to attach metrics to everything that he's doing, but we can all see it's been sort of a user and ideological shift, but also a gatekeeper and a guardrail shift in terms of what kind of messaging is spread on formerly Twitter, now X, and who likes to use it. And I think we've seen a lot of movement from some users and some
Margaret, one last question just quickly. So shame on social media velocity, shame on social media companies, shame on all of us who read so much social media and kind of create that velocity, or shame on just the money in politics to the extreme level that it has become? And just quickly. Money undoubtedly has an impact in politics, but it's also voter beware and consumer beware. There are a lot of efforts to manipulate you, whether it's to take advantage of you financially, to misinform you, to bend your vote, to confuse you, or just to prod you in a certain direction. You have to understand when you're consuming information, it does influence the way you think about issues. Eyes wide open. Margaret Talev, so nice to be checking in with you. Have a great holiday and Happy New Year. Director of the Institute for Democracy, Journalism, and Citizenship at Syracuse University, former senior White House correspondent for our team here at Bloomberg News. So great to reconnect. Joining us from Washington, D.C. What we do need to reconnect with is what's going on with FedEx, because the stock's up about 10% in the aftermarket. This on news that FedEx plans to spin off its freight division, a move that will advance the company's CEO's push to really streamline the parcel giant. To make sense of it all, Lee Klaskow is with us. He's Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, joining us from BI headquarters in Princeton, New Jersey. Stock is off and running. Does this make sense? Smart move? Or help us understand why investors are so excited? Is it just about unlocking value, or is it because it's good business strategy?
I think both. Some might. While FedEx used to tout the fact that they used to cross-sell, a lot of their businesses to their customers, it could come in question, how good is some of the margin business of, if you're using, I'm not going to say it's a loss leader, but you might be able to give a little better pricing on your LTL business if you're going to get more lucrative parcel business. And so, I think this will really unlock some value. LTL carriers tend to trade at a higher multiple than parcel carriers. It's also a very consolidated market. It's a good market. It's a much better market than the truckload market. The top 10 players have about 75% of the market share, and it's also a market that has a lot of price discipline. The industry kind of learned its lessons in, call it 2005, when they were all trying to put Yellow out of business through pricing. That didn't work, and it kind of backfired. And companies like FedEx Freight, it took them a long time to recoup some of those poor yield decisions. And it's also worth noting that FedEx Freight is a leader in the LTL business. It's the largest LTL carrier in North America. And I think that, they have still opportunities to grow that business, and some of that business, like I mentioned, could even come at better margins than what we're seeing today. And it'll allow, management to truly focus on improving that network and building density to improve margins.
Lee, hang on for a second. We do have FedEx shares, as we mentioned, up 10% on news that it's spinning off its $30 billion freight unit to streamline the company. Having said that, Nike is also out with its earnings, and that stock's up almost 12% in the aftermarket. This has revenue tops estimate. Second quarter revenue was $12.35 billion. The estimate on the street was $12.13 billion. And also keep in mind, we've got a new CEO at this company, and he is confident of Nike being Nike again. This is some commentary. He also says taking immediate action to reposition this company. So again, investors like what they are hearing. We're going to get back to Nike a little bit later on, but we want to continue with what's going on in FedEx, because this is a big this is a big news for this company.
Yeah, let's get back to Lee Klaskow on the news that FedEx said it plans to spin off its freight division. It'll advance the CEO's push to streamline the parcel giant. Lee, help us understand the context here, because Bloomberg Intelligence estimates the freight unit has an enterprise value of more than $30 billion. How does that compare to the parcel unit? Just explain the two different roles here, because I think a lot of customers, a lot of consumers are familiar with the parcel unit of the business because that's the one that's consumer facing. Talk about the LTL business too, though.
Yeah, so the LTL business is exactly that. If a shipper is trying to move a couple boxes or a pallet, LTL carriers really prefer palletized freight. And so, what they do is they consolidate the freight, and then they'll move it from, they'll take a bunch of different shippers' freight, call it from the New York City area, and they'll build a truck and send that truck off to Chicago, and then they'll break down that truck, and then they'll bring that freight for delivery to the local markets. So it's almost like a parcel business, but when you're talking about palletized freight, and it's mostly B2B, it's heavily driven by industrial production, and the ISM are great indicators for where LTL demand is going to go. The industrial production is expected to accelerate next year, so that's good news for LTL. The bad news is the ISM has been in contraction territory, I believe 24 of the last 25 months, so that might spell some kind of demand headwinds near term.
Will FedEx's parcel business, its core business, be a customer of FedEx's LTL business? That is, when that truckload gets to Chicago, will then the last mile be delivered by FedEx quite a bit?
Probably not. There might be some freight that FedEx Freight might be able to deliver for ground or parcel if it's maybe something that's not conveyable, exercise equipment or furniture or something to that effect.
Surprising to see a move such as this. I know Bloomberg Intelligence did estimate the freight unit, so you had numbers on this, but surprised to see a move like this?
No, they've telegraphed that they were going to do it a while ago, and we kind of were hoping that we'd get some sort of resolution. So it was a binary kind of decision. They were either going to spin it out or not spin it out. We didn't necessarily think that a private equity or somebody else like a strategic buyer would be out there. So we thought the odds that if they were to divest that business, it would be through a spin out, and that seems to be what they're doing. And it allows the parcel shareholders to benefit if they want in that business as well.
Hey, Lee, just one last question. I pulled up UPS in the aftermarket. We're not really seeing much of a move, but is there any implications for UPS? I know they're not apples to apples, but they do play in the same world.
Right.
Any implications there?
So UPS sold their LTL business a couple of years ago to TFI, and that was a highly unprofitable business for UPS. Some years it made money, some years it didn't make money, and when it made money, we're talking about very low single-digit margin. So they were getting rid of definitely a loss leader. TFI is kind of turning around that business as we speak, so that's good for that business. But it's definitely FedEx Freight LTL business is a much more profitable business than UPS's LTL business that they sold.
Well, speaking of making money, some FedEx investors are making money here, at least in the aftermarket right now. That stock up just shy of 9%. Lee Klaskow, thank you so much. So appreciated. Senior Transport, Logistics, and Shipping Analyst with our Bloomberg Intelligence team. We'll be watching out for some of his research today at the Bloomberg Terminal a little later on.
Bloomberg Business Week is brought to you by the Jewish Communal Fund. JCF helps you respond to crisis swiftly. Open your JCF donor-advised fund now to secure your tax deduction. Visit jcfny.org or call 212-752-8277.
All right, so FedEx rallying in the aftermarket. Yes, the big news about it spinning off its freight unit. In the meantime, you've got shares of Nike soaring in the aftermarket. Stock's up just under, about 9.3% as we speak. The company reported sales that surpassed analyst expectations. So the new CEO, Elliott Hill, he's got a positive development to talk about during his first earnings call. You might recall that he took that top job in September, Tim.
Yeah, we got with us Poonam Goyal, Bloomberg Intelligence Senior Analyst for E-commerce, Athleisure, and Off-Price Retail. She joins us from BI headquarters in Princeton, New Jersey. Poonam, talk about a good first report for Elliott Hill, no?
Yeah, absolutely. Revenues beat expectations, and what was interesting was that the beat came from apparel and wholesale. So I think that was really nice to see, especially on the wholesale side, because we know that they're making a big push back into wholesale with Foot Locker and others, and it is paying off.
You should note, just real quick, Carol,
please.
sales of Foot Locker up in the after hours by about 4% in sympathy as a result of these Nike earnings.
So, Poonam, remind us of what their problems were, the issues, and what have they done, or what do we know about how they have maybe improved that in terms of the retail environment?
The problems have not been solved, right? I think we're going to hear on how they're going to solve them. The biggest problem that Nike has had is that it had lost momentum in two key categories, running and lifestyle, where others had come in and taken share. Are they working to rebuild that? Absolutely. Product pipeline, execution, getting back with the customers through runs and just building those communities again is going to help that. We're still waiting to hear from the new CEO, Elliot Hill, on what the plans are to do so, and we hope to hear that in the next calendar year. That said, they have started to improve their product pipeline. They have started to pull back on inventory, clearing unwanted items, and really beginning to clean house. And that's what we're seeing now. We're seeing some very early results of that, but the work isn't over. This is just the start, and there's a lot more to go from here.
When you say lifestyle, what does that encompass? Because that's a hard thing to turn around if an image of a brand has changed significantly, especially with a demographic of a population that doesn't understand what Nike used to be.
Sure. So lifestyle is what you wear when you go out, right? You're going to the mall, you're hanging out with friends, you're just walking around. That's lifestyle. Now, when we think of Nike, Nike is a big brand, and it is still the largest athleisure brand in the world. People still know Nike. They still want Nike. In fact, we ran a BI survey last month, which showed when asked across multiple categories, what do you want to wear on your feet? Nike was the top choice still. So Nike hasn't lost that mind share, but they've just lost the connection with customers in those categories. And I think it's about building that again, and product is key for that. They kind of went astray from product, and now they're going back to product. Product is still king in retail, and Nike's just coming back to it.
And yet there's a fair amount of competition. You know this better than anyone, right? Whether it's On or whether it's, I don't know, pick Deckers. I mean, there's a lot of companies out there that are kind of, I don't want to say gunning for Nike, but man, it gives consumers, I think about it when I'm on Instagram, the stuff that just comes at me, and I'm like, oh, look at that brand, like that sneaker brand or something. There's so much out there.
There is, you know, the Hokas, the Ons, other brands, even Adidas, right? There's just so many brands that have stepped up their game when it comes to footwear especially. But at the same time, you know, if Nike continues to push on innovation, if they get the right product out there, they have the deep pockets to compete. They can get the endorsers. They can get the communication out to people to really prop up their brand. They just have to do it. So I think they still have a chance.
What about the younger consumer and how important that is? Are they gaining ground? Are they, you know, is that of interest? And, you know, do you create kind of a lifelong consumer here, or not necessarily?
Yeah, absolutely. I think Nike has the younger consumer. I don't think they've lost it, especially when it comes to sports like basketball, right? Nike's still the top sought-after brand. So I don't think it's that they've lost appeal with the younger customer. I just think it comes really back to product and connection across all demographics, across all age groups. And Nike just lost its footing with them. And it's not something that can't be turned because they still hold top mind share. They just have to come back at it. And we're hoping that Elliot Hill will outline a plan in calendar 2025 that will show just how he is going to do that.
What about when it comes to the business outside of the U.S., Greater China specifically? Yeah, go ahead.
Yeah, so China was weaker, actually, and we'd like to hear more about that. The other regions did better than what consensus had expected, but China was down. Greater China was down 11% in constant currency. So there's clearly still some hiccups there, and there are other brands that are, you could argue that, you know, it's not just Nike that's facing this problem, but then there's Lululemon that is doing phenomenally well in China. So there is a disconnect, and we'd want to hear more when the call begins today.
Elliot Hill is someone who knows this company well. I, you know, just reminded that he was started as a sales intern in 1988, worked his way up over 3 decades. Is it important that there is somebody at the top job, Poonam, in your view, that really understands this culture without getting too caught up in it and is not able to then move forward?
I think it is. I think it'll be helpful. I think, coming back to product and just coming back to making sure that you have, at the end of the day, it's a product that you're selling, right? So you have to have the right product and you have to make sure that the innovation continues day after day. And I think he understands that. It's in the DNA. We saw that as soon as he joined, the first thing he did was bring back leadership, right? That knows the Nike DNA. And I think that's a positive move. I think that's a move that's in the right direction. So we'll wait and see what happens, but we do think that the steps so far do position Nike for that turnaround that it's looking for.
Hey, really quickly, just 25 seconds. What's your number one question if you're sitting down with Hill? What would you ask him?
My number one question is, how do you get customers to connect with Nike again in running?
All right, good stuff. As always, Poonam, thank you so much. Poonam Goyal, she's Senior Analyst for E-commerce, Athleisure, and Off-Price Retail at our Bloomberg Intelligence team. She's right there at our BI headquarters in New Jersey. Again, shares of Nike up more than 8%.
Yeah, shares in the after hours of FedEx also higher after the company reported that it's spinning off into two units. Its freight unit, its LTL business. Shares of FedEx up 7.7%.
Yeah, both of those stories a reminder that fundamental news, earnings news, that can definitely get stocks moving, and that's something that we're going to be thinking about as we move into earnings come January. Right now, we're thinking about a really interesting interview happening over on our Bloomberg TV team. We go now live to our live simulcast with Kathy Wood, CEO, CIO, and founder of ARK Invest, and Rebecca Kakaba, CEO and co-founder of Dealmaker, sitting down with Romain Bostic and Scarlett Fu.
We welcome back our Bloomberg Radio, TV, and YouTube audiences worldwide here on The Close with a discussion about unlocking venture capital wealth. That's the mission of our next two guests, who are working to expand access to opportunities usually just reserved for the big guys, the institutional investors. Joining us right now is the face of the rise of the retail investor, Kathy Wood. She's the CEO of ARK Invest. You know her. She's joined alongside Rebecca Kakaba. She's co-founder and CEO of a company called Dealmaker, which is revolutionizing how companies raise capital by providing a tech-driven platform for companies to use. Welcome to both of you. And I'm going to start with you, Rebecca. We all know Kathy, and we all know just how responsible she is for a lot of the democratization, if you will, of a lot of investment vehicles. You're also doing something similar, and I'm wondering if you just kind of explain how Dealmaker fits into that landscape.
Sure thing. So what we're doing is bringing a really technology-driven approach to raising capital. If you think about it, if you reinvented capital raising today, it would be on the internet, it would be data-driven, and it would be democratized. And so that's what our technology brings. It essentially allows you to run ad campaigns and target investors who might be interested in your deal based on their digital profile.
I am curious, Kathy, about these new types of platforms. We talk about the evolution of financial markets. We went from a day and age where financial markets were just for institutional investors. Then you had, of course, the rise of mutual funds, and then ETFs, of course, and then now a lot of new products in the private space are now trying to draw in individual investors. This is just the natural evolution as you see it?
Yes, it's natural in a way, but I think during COVID, it was turbocharged. A lot of, especially younger people who would not meet the accreditation standards, they were learning about new companies, investing themselves, trying to figure out what these new technologies were all about, and happened upon private companies to which they had no or little access. And I think because of that, and because I know we started our venture fund for that reason, they came to us and said, how is it, we don't have enough, we don't make enough money, $250,000 per year, I think it is, and we don't have $1 million in net worth to become accredited and have access to these incredible technologies early in their lifetimes. Can you help us solve that problem? And so, yes, that's why we started our venture fund. It has no carry, and people can have access to SpaceX and OpenAI, Anthropic, XAI, X for as little as $500.
Okay, so that's one solution to democratizing access of these companies to everyday individual investors. Kathy, could you explain a little bit about what it is that ARK is doing with Dealmaker?
Well, our venture team met Rebecca recently, and I have yet to be briefed on exactly what we're doing together. Maybe Rebecca would want to talk about how far along we are.
Yeah, I think it's opportunities like this where we can understand, we can talk to Washington about what the investors and what the companies want. Like Dealmaker is taking a slightly different approach on it, where we see retail investors having a bit of a distrust of institutions today and companies wanting that one-to-one relationship with the brand. And so we're both two different businesses taking a totally different approach to the retail market, but understanding the power of this and how it can be transformative for the capital markets in a lot of different ways. Because let's face it, there's a lot of ways that the capital markets ecosystem is broken that both what ARC is doing and Dealmaker is doing can help solve.
I was kind of going, I'm sorry, go ahead.
So I was, that's what I thought had happened. We are so like-minded. Charlie Roberts, who leads our VC effort, and Rebecca met at a conference, and we just thought, okay, we're both going at this from in a little bit of a different way from different angles, but this idea of democratization is in its very early stages, so let's make sure we both encourage it.
Right, you both encounter the same issues and you're looking to solve it in your own ways. So Rebecca, can you talk a little bit about the biggest pain points of capital raising that founders tend to face and how Dealmaker solves for that?
Yeah, I mean, ultimately, access to capital.
On the latest edition of the Bloomberg Business Week podcast, a conversation with Jake Silverman of Bloomberg Intelligence on Micron missing projections due to sluggish demand for smartphones and personal computers.
And then there's a lot of brands that retail investors love and they want to participate in, and they can help amplify the business in a different way. So we have technology companies, you know, Monogram's building a robotic knee surgery arm where they've got retail investors forming all of their beta users and really supporting bringing that business to life and driving revenue for them. So the reality is that businesses are built online today, and there's a lot of different ways that retail can interact with these brands to help propel them forward.
Was there any issues when you were starting this, Rebecca, and was there any issues about regulatory concerns? I mean, we know that regulators, particularly here in the U.S., look over their shoulders and they sort of, I think kind of Kathy alluded to, look, they're saying, look, you don't have the net worth, so you must not be sophisticated enough to buy this type of vehicle. How did you navigate that regulatory side of this when you were coming up with this idea and building out the business?
Okay, well, shameless plug. I think the regulators were brilliant in the way that they designed the legislation, because the legislation protects investors already. So they put a cap on the amount that a retail investor can invest when they're not accredited. So they're not going to lose their shirt on any one single offering, because we know some offerings are going to succeed and some offerings are going to fail. And so the main thing that we're driving for here is to make sure that the investors are protected, and the legislation did that already. And so there's a bill in the House right now that's probably going to pass with the new administration that we're going to see the exemption limits go up from 75 million to 150 million. You've also got FIT 21, which is going to bring a lot of interest to the crypto space. So we see the snowball just rolling now in terms of retail access to alts.
Kathy, I do have to kind of ask you about the climate in Washington, and I know you have a lot of friends, either business-wise or personal, in the incoming administration coming in, and there's been a euphoria. I'm sure you've seen it ever since November 5th, even slightly before that, when it became somewhat clearer that Trump was likely going to win. He's promising, obviously, a much more business-friendly administration, one of deregulation. At the same time, he's also pitching fiscal policies that could potentially have some economic impact to the negative side. I am curious as to, I guess, what type of euphoria you're feeling, and more importantly, what type of caution, if at all, you're feeling as well.
Well, if you look at our the performance of our funds since the election, they've far outpaced the market, outpaced the Mag 7 and so forth. So I think what the market is beginning to say is this administration is going to support innovative strategies, anything that will accelerate the growth, increase the productivity, of our economy. Deregulation is going to be, we think, a very large part of that. Tax incentives, tax rate cuts as well. You mentioned perhaps the cutback in government spending programs. You know, in our mind, government spending, longer term, is taxation in one form or the other. It's got to be paid for with increased taxes now, increased taxes later, or basically through inflation, inflating away the debt. So we think that's going to be very positive, this drive towards increasing the efficiency of the government, which will then limit the kinds of tax increases we've seen over the last few years. And perhaps even continue to roll back taxes, leaving more for the private sector at the expense of sort of inefficiencies in the government sector.
So, Kathy, following on that, the president-elect has outlined a number of initiatives that he wants to put in place as soon as he is inaugurated on January 20th. Of the different proposals, the pro-growth items that he has on his to-do list, which do you think needs to be prioritized? Is it tax cuts? Is it immigration reform? Is it tariffs? Is it deregulation? Which of those things should be at the top?
Well, consider the source. So my answer might be different from President-elect Trump's answer. But in terms of turbocharging growth, I think if tax rates, if this administration is going to cut tax rates, the most important thing it has to do is make sure they're retroactive to January 1st of 2025. Because, and we learned this from the Reagan administration, if they defer or phase in tax cuts, businesses and individuals will wait for the lower tax rates, and that can weaken economic activity. Beyond that, deregulation, critically important. I think one of the reasons venture capital has had so much trouble during the last few years and strategies in the innovation space, especially in life sciences, is because M&A has been prevented by the FTC. That is going to change. So we are finally going to have price discovery as strategic buyers bid for these innovative companies. We'll see how much they're really worth. This has not happened in a long time. Yeah. We also think, therefore, there will be liquidity events for private companies into the public world, which is also going to become very important.
Well, Rebecca, I'd like to get your thoughts on that as well, because when you look at the data, certainly in the first half of the year, I mean, VC funding activity was abysmal. We saw definitely a bit of a pickup in 3Q. I'm not sure what the fourth quarter has shown, but are you optimistic we're going to see more VC activity, kind of to the point of what Kathy was talking about in terms of the catalyst? Is that going to really push this industry forward?
It definitely feels that way. It really does. I think the momentum is there. The street is excited and feeling the effects of deregulation. And, you know, one of the benefits that we saw over the down market activity was that retail investors stay strong. Like, while VC activity dipped, retail investment continued to pull through and continued to carry a lot of the capital markets, which was what Congress intended when they originally passed the legislation. So we expect to just consider that upswing continuing.
Kathy, you had mentioned the ARK Venture Fund. I'm wondering, with this new administration coming in, the deregulation that you talk about and the things that they can do to really get the economy going and get companies going, do you think that startups will choose to stay private less? They'll start to look to the public markets as an engine of growth, more so than they have in the past couple of years?
Well, it depends. If there's more deregulation and if the red tape associated with going public starts to disappear, any company that wants to scale very quickly, And especially if they have anything, if they're at a higher fixed cost base, the robotics industry would be one example of this. They would probably scale faster in the public market. So we think it would be fantastic to have both markets operating efficiently. One encouraged by more M&A activity as we change the leadership at the FTC. And the other one, just enjoying the lower red tape associated with less regulation. So we think this administration is going to be very pro-business. And is going to be that's going to be a big reason that the growth rate of the economy is going to accelerate in the next few years.
Kathy, I do want to get your thoughts on Elon Musk and his role in this administration, particularly given we know that ARK is invested in many, if not all, of his companies. He's wearing a lot of hats, and now he's got the Washington hat on, in theory, starting in January. I mean, how much do you think he can do, given that he's not technically going to be in an official role? And do you worry at all that his work in Washington might come at the expense of the attention to his actual companies?
Well, I think one of the reasons he is dedicated to this is because his own companies have faced such regulatory pressures and obstacles, and he just knows he could change the world even faster than he already has. If he got some of those obstacles out of the way.
But Kathy, can he do that safely, though? And I'm just playing devil's advocate here. I mean, a lot of those regulations are, you know, kind of meant to kind of protect the consumer to a certain extent from car crashes or whatever. You know, it's one thing to move fast and break things. It's another, you know, to break your customer.
No, I think if you listen to Elon Musk and safety and focus on delighting the end consumer, you know, Tesla has the safest cars in the world. And yet the regulators in the last 4 years have focused on almost every accident and fatality in an accident in a Tesla car, as opposed to in the other 40,000 accidents. So I think that he understands that there is an important place for regulation, that safety of the consumer is paramount, that we're not going to neglect that, but there is such a thing as regulation gone too far. I've seen statistics that in the last 4 years, regulations piled one on top of the other, and from different departments have taken 6 percentage points off of real GDP.
Yeah.
So that has to change.
And also to that point, though, Kathy, and I want to, this question is to you, Rebecca, and it really has to do about the idea of business creation. There's been a lot of stats about how business creation has just really just shrunk. Now, some of that's just because of the pandemic and a few other things, but there has been a lot of theories about government regulation, government oversight, maybe putting a little bit of a squash on that. Do you hear from that with some of the startups and entrepreneurs that you deal with on a day-to-day basis?
Yeah, for sure. I mean, when Elon said so himself, right? When Elon can build a rocket faster than he can get it approved to launch, you know you've got a fundamental problem that's slowing down innovation. So, of course, as a tech CEO, I'm very excited to see what he can accomplish applying engineering concepts to government. As retail capital, you know, from direct to investor retail, we saw even in a down market, 5 issuers that raised on Dealmaker go public on NASDAQ during the last year. So I think as we open up new categories, new ways of building businesses and having those be digital and what that means, there's different things that are going to emerge and different trends that are going to emerge. And definitely one of the trends that we saw was a lot of our companies are tech and robotics companies, and now more emerging sports teams as well. We're going to see a whole different changing landscape of companies going public sooner.
Kathy, I can't resist asking about Tesla since we were talking about Elon Musk. I know that your funds have been actively trading this week. ARK Fund sold about 164,000 shares of Tesla this week. I'm guessing this is tactical, but I'm wondering if post-election there's a fundamental change in the story when it comes to Tesla.
Well, I think one of the changes, again, back to regulation, is the likelihood that autonomous mobility, so robotaxis, are going to be regulated not on the state level, so 50 different regulators, but on the federal level. After all, autonomous vehicles will travel from state to state, so it really should be federal legislation. So I think that will speed up the move towards autonomous taxi networks. And I do believe for that reason, investors, analysts are starting to model out what that will mean to the Tesla model. It will take their gross margins from mid-teens right now up into the 60s if we are right, because robotaxis and autonomous taxi network is a SaaS model. I think the other thing that has happened is more and more people are seeing videos of the humanoid robot doing all sorts of things that we didn't think were possible as the dexterity in its hands gets so much better.
Yeah, and to your point, analysts over at Mizuho do see idiosyncratic tailwinds over the next 4 years for a company like Tesla upgrading their price target there. So when it comes to autonomous vehicles and all that, there are reports that Honda and Nissan are exploring some kind of tie-up, maybe a merger. Would a combined company create a worthy competitor to Tesla or Chinese EV makers even?
Well, I think that anytime there is a combination of two companies, it takes a while for the integration to take place. So if anything, we would think if there is a competitive dynamic from those two companies associated with autonomous, that it will be delayed. More competition for EVs is coming from China, no question. Now, we have very big tariffs already in place to prevent that here in the United States. And we'll see what happens with the administration. I think that Elon Musk is not worried about competition if we're talking about Tesla.
Yeah.
He's driving the cost curves down dramatically for his own company. So he's not worried about losing the EV tax credits either. He doesn't need them. He will be profitable. Tesla will be profitable without them.
Kathy, I do want to pivot here and ask you about some of the market action, particularly over the last few months, and particularly when it comes to crypto. I'm sure you've seen the big run up in Bitcoin briefly above 100 grand. Now back below that today, but certainly phenomenal run on a year-to-date basis from where it was just a few months ago here. Do you still sort of see Bitcoin really hitting some of those lofty milestones that you've talked about before? 100,000 is still a long way from 1 million. I do kind of wonder how much further you think this could actually go.
Well, what's interesting about Bitcoin today, now that we're going to get more regulatory green lights, we're seeing institutional investors focus on this new asset class. And as they're learning about it, they're saying, wait a minute, this new asset class, or this component of a new asset class, Bitcoin, is going to reach 21 million units out there, 21 million Bitcoin out there at its peak, and no more from there on. Where are we now? We're already above 19.5 million units. And so if institutional investors are looking at this new asset class more seriously, and Bitcoin is really the first of its kind in a new asset class and will be, we believe, the biggest opportunity of them all, they must consider an allocation. And so supply-demand, they're doing the arithmetic, and we see 1 million to 1.5 million by 2030. The probability of that has increased because of institutional.
Okay, so that's 6 years from now. And I understand the supply-demand dynamics, but Kathy, I'm sure you're also very aware of some of the main criticisms that there really is no, I guess, fundamentals, if you will, at least in the traditional sense of how we try to value stocks or hard assets here. So beyond the speculative nature of I buy this and someone will buy it for more than me down the road, is there anything else there that gooses this beyond just that supply-demand equation?
Well, I think it's a very big idea, and it's not just speculative. It's a global monetary system that is rules-based, it is private, it is digital, it is decentralized, and it is backed by the largest computer in the world, or the largest computing system. It's the most secure network in the world. So that's very important. Gold would be in the same category. Gold is a store of value. And it is fairly scarce. What's interesting, in the last year, with the last halving this April, the increase in Bitcoin, the number of Bitcoin per year, the percentage increase, dropped to roughly 0.9% per year. That is below the 1% long-term growth in the supply of gold. So it is becoming even more scarce than gold. And the difference between gold and Bitcoin is when the gold price goes up, as it has, production goes up, the rate of increase in the supply goes up. That cannot happen with Bitcoin. It is mathematically metered to go up now 0.9% per year for the next 4 years, and then the supply growth will be cut in half again. So we think you can use gold as a guide